Look, thanks for the introduction, Anthony, and for Melina for the invitation to come and speak to you today. I was very much involved in Fonterra's development of Trading Among Farmers, but that was 7 years ago when I first went from Sydney, where I'm from, to Auckland to do that. And I spent 3 years at Fonterra, so I've left Fonterra 4.5 years ago. So I'm not representing Fonterra today, I'm very much independent. I work for a company called Syndex now, but you won't see any Syndex logos on here because Syndex wasn't even around when I did the work at Fonterra. First, I'll sort of describe what sort of Fonterra is and why it's different, because Trading Among Farmers itself is a unique solution to a unique problem, which is Fonterra, because it was formed under legislation back in 2001, where at the end of a period of amalgamation of New Zealand dairy co-ops. First New Zealand dairy co-op started in the 1860s, and through the 90s there was a period of smaller localised co-ops growing into regional co-ops, growing up into what ended up being two dominant dairy co-ops in New Zealand, coupled with the New Zealand Dairy Board, which is a sort of government-sponsored marketing arm of New Zealand Dairy. And the government of the day, a Labor government of the day, allowed for the merger of those two large dairy co-ops. Two other smaller ones chose not to join, with the New Zealand Dairy Board to create Fonterra back in 2001. And that became a dominant player in New Zealand. It's the world's largest dairy exporter, and it ended up collecting about 94% of the milk in New Zealand. So under a government mandate, you ended up creating a near monopoly in New Zealand. And as they were doing that period of amalgamation, many co-ops, unlike Australia, and you'll note through my presentation today, some things in New Zealand are different to here under co-op law, and Robin no doubt will be able to point out what those differences are. One of which many of the co-ops had already moved to fairly valuing their shares rather than a nominal value for their shares. And that was to reflect the value different co-ops were bringing to each other as they were merging. And so the members of that co-op adequately reflected what they'd built up over time. And that happened in the case with Fonterra. Fonterra, under legislation, actually had to have a fair value share. Weren't allowed to have a nominal value share. But because of the near monopoly that it was creating, the government of the day was concerned with maintaining competition in the market, and within the Dairy Industry Restructuring Act, which was the act that allowed the formation of Fonterra, there's two particular pieces that were included to maintain competition in the New Zealand market. And the first was Fonterra must take milk from anyone who wanted to milk a cow. So if you wanted to convert your farm from a beef and sheep farm or from forestry and you wanted to convert it to dairy, Fonterra, and you rang up Fonterra, they're obligated to pick up your milk. Fonterra couldn't say, sorry mate, we're at capacity, we can't pick it up. So if you're a CFO in here, you'll understand that immediately comes with a capital issue. So you have to take milk, you therefore have to build processing capability to take that milk. You can't choose not to take it. And then the second issue in the legislation related to competition is that farmers must be free to enter and exit the co-op at the time of their choosing. So if a farmer decides to want to join the co-op to get his milk picked up, Fonterra can't say once again we're full, must be allowed to enter the co-op. And secondly, if a farmer wants to leave the co-op because they want to supply someone else or they want to go back to beef and sheep farming, Fonterra must let them leave, but perhaps more importantly, Fonterra must pay out the value of their shares. So these are two real capital constraints which came with the competition clauses that Fonterra had to accept as part of being allowed to merge those two big dairy co-ops in 2001. So what were the problems Fonterra was trying to solve when they started looking at their capital structure in the mid-2000s? And the first one was the provision of permanent capital. You'll see much of Trading Among Farmers is actually to do with permanent capital as opposed to raising capital. But your solution, which I'll get to a little bit later on, ends up having capital raising capability, but it wasn't why they did it. Okay. The first one is creation of permanent capital. And once again, for those of you who are directors in the room or CFOs or CEOs, this is the sort of stuff that keeps you awake at night. Is in the year where New Zealand had a particularly bad drought. For those of you who aren't Kiwis or haven't worked in New Zealand, a drought is a period of about 3 weeks without rain, really, believe it or not. Particularly bad drought, when that happens, production goes down. Production is very much linked to the ability to grow grass, and the ability to grow grass is linked to how much rain you get. So when production fell, farmers were in a position where they could sell some of their shares in the co-op to try and see them through the hard times. Fonterra, you have to have 1 share for every kilogram of milk solids you produce. So in a year where your production fell, because there's less rainfall, you have surplus shares, you sell them back to the co-op. And back in 07-08, there was a particularly large redemption event where people were redeeming shares, over $740 million Fonterra had to come up with in a period of about 6 weeks. Now, if you look at the time, 07-08, what else was going on at the same time? Global financial crisis, and the ability to attract liquidity in the global markets was near impossible. This is the biggest company in New Zealand suffering an event related to weather, couldn't do anything about it, struggling with a redemption event which really was a result of the requirements they have under the legislation. So Fonterra ended up solving that by eventually borrowing offshore at penal interest rates, some of which I believe are still outstanding today, they're still paying for. These are double-digit interest rates of $740 million. So the provision of permanent capital was really the driver for Fonterra and Trading Among Farmers, that what they describe as redemption risk. The risk of capital washing in and out of the balance sheet at short notice, which really affect their ability of directors to be able to plan the future capital needs for the business. And then the second real goal they were seeking for Trading Among Farmers is to create more flexibility for their farmer shareholders. As I mentioned, anyone that wants to milk a cow can get their milk picked up by Fonterra, but they have to own a share in the co-op. And the average farmer in New Zealand milks about 110,000 kilograms of milk solids. That means 110,000 shares. And prior to the launch of Trading Among Farmers, the share price was $4.52. So before Fonterra will pick up your milk, you have to go buy $500,000 worth of shares in the co-op. That's after you bought the land and after you bought the cows. And with increasing competition for milk in New Zealand, you've got offshore players building processing plants in New Zealand. The concern the co-op had was if they didn't try to make it easier for people to join and then stay in the co-op, they're going to start losing milk supply elsewhere. So these are the two problems Fonterra was trying to solve with Trading Among Farmers, which ended up becoming the solution, but it was the end of a period of about 7-8 years of capital restructuring. And as the name suggests, the relatively simple solution was that when you wanted to buy into the co-op, rather than going to Fonterra and giving Fonterra money, you would buy the shares from a farmer who wanted to sell some. And similarly, if you wanted to leave the co-op, you wanted to go back to beef and sheep farming, or you wanted to go to another supplier, you would just sell your shares to another farmer. Now, the beauty of that from a Fonterra point of view is that no longer are they in a situation where they're going to have to redeem shares on an annual basis. It creates that permanent capital they're concerned with, rather than being concerned with capital washing in and out of the balance sheet on an annual basis. But that actually creates a bit of a problem. This is the time when I really came into the market, because my background is financial services and technology and capital markets. And the problem with a market that only has New Zealand-based dairy farmers in it is they're all the same. They're homogenous. So in the event of like 2007-08, everyone's a seller. It's what we call one-sided trading in markets. So the problem with that is it affects price discovery and it affects what farmers pay and get when they sell their shares. And the solution to one-sided trading is actually to diversify who's involved in the market. You need to get people who aren't just New Zealand-based dairy farmers in there to try and improve what we call price discovery. And of course, if those of you involved in co-ops are concerned with that, is you stuck any external players in your co-op, and no one in a co-op likes external players mucking around in the co-op, especially New Zealand dairy farmers. So they recognised the need to improve liquidity, and they recognised the need to diversify who's involved in the market, but they did not want to give up 100% control and ownership. And this is part of a presentation I used to do to farmers 70 or 80 times around the country, and was reinforced time and time again, was, Aaron, do not sell my co-op from under me, whatever you do. Very, very sacrosanct to the shareholders of Fonterra that whatever we did to solve this redemption risk, is we were not to give up 100% control and ownership. And it became very, very political within the co-op. Many farmer meetings, many friendships lost over it, but this was very much a non-negotiable for them. So a hybrid solution was born, and when I used to have farmer meetings like this and say, Aaron, can you point to elsewhere in the world you looked at to design this? Well, we couldn't, because there wasn't a government essentially sponsored monopoly anywhere that had developed a solution for a redemption risk problem. So we ended up having to come up with a hybrid solution. I certainly wasn't the designer of it. I came help to put some of the skin on the bones. So how was that solved is, well, firstly, this is a slimmed down version of Robin's slide from earlier, is what do you get when you have a share in the co-op, and this is a little bit different once again to Australian co-ops, is firstly you get a vote. And unlike some of the voting rights we heard about earlier here in Australia, is in Fonterra at least, you get one vote per kilogram of milk solids, assuming you own a share for each one of those kilos. So the bigger farmers get a bigger vote, is what that means. And one of the reasons for that is because they've got more invested in the co-op. Very, very capital intensive dairy farming. If you think of milk being heavy, every litre weighs a kilo, it's very perishable. It needs to be chilled virtually immediately as it's milked. It needs to then go to processing and be dehydrated virtually the same day. And dehydration plants are big stainless steel things that are very, very power intensive as well. So a lot of capital is tied up in stainless steel for a dairy co-op. Hence, the bigger you are, the more money you have invested, and therefore your voting is linked to that. And then you also have the right to have your milk collected. As I said, we're not obligated to pick up your milk until you have bought a share. And then unlike some co-ops here, you get to share in the profit of it, just like any other listed company. You get to share in the profit via dividends, and you get to benefit from the value of the co-op changing up or down by your share price adjusting. And what Fonterra did, what Trading Among Farmers does, is essentially split a share in half. And what Fonterra farmers get to keep is what's on the left. They sell a share to an external investor, but the internal investor only gets what's on the right. They only get access to the dividends, and they only get access to any changes in the value of the shares. What they don't get is a vote, most importantly, and not that they care about getting their milk picked up. Right? But what's important about that is not giving up any control and ownership of the cooperative. All an external investor is getting is the economic benefit of a share, not the actual benefit. So I'm actually going to bring the whiteboard over now. It's a little bit smaller than I was hoping for, so I'm going to do my best for you as you up the back to try and draw now actually how it works. So bear with me as Dunk brings it over. So it's all very well for saying you have external investors and farmers get to keep the share, but actually how does it work? And starts with what we call the Fonterra Shareholders market, and this exists today, and this is where farmers can go and buy shares amongst themselves. Right? This exists now. It's a private market, only open to Fonterra share farmers, and they could do that every day of the week. Now, of course, farmers are milking cows every day. They're not actually trading shares. And as I mentioned before, is the risk of, in this particular market, of one-sided trading. And because farmers are they're milking cows every day, it's likely to be illiquid as well. That is, not going to trade very often. Right? So that affects price discovery, and it affects the ability for a farmer to sell when they want. So at the same time, Fonterra created the Fonterra Shareholders Fund, and for those of you at the back, I hope you can see that. I'll leave it up here afterwards, and I'm happy to take questions afterwards as well. The Fonterra Shareholders Fund is listed on the NZX and listed on the ASX. You can go look at the code. If you've got your phones now, you look at FSF on the ASX, you can look at that on the same as the NZX. Traded amongst the public. So this market has institutions, has super funds, has mums and dads, has people in Australia, has people in New Zealand, has people offshore investing in it. The beauty of this market is that it brings the diversity in that we talked about before, and it diversify who's involved in the market. to try and improve liquidity. And the beauty of this is that is the most liquid stock on the New Zealand Stock Exchange. The question is, how does that Fonterra Shareholders Fund actually benefit the co-op, and how does it benefit a farmer concerned with selling their shares or buying shares but not giving up control? The way that works easiest to give you an example is, let's assume a farmer wants to sell some of their shares in the co-op. They're selling out, or their production has dropped, so they need to sell some shares. So let's say they want to sell 100 shares. There's a farmer wanting to sell 100 shares. There's no farmers buying today. The farmers are out milking cows. So what happens technically actually is, when we do that under Trading Among Farmers, is those 100 shares get locked up in a custodian called a lockbox. That's a padlock, for those of you who can't appreciate my drawing. Those 100 shares go in that custodian, they're locked up, and as that happens, 100 units in the Fonterra Shareholders Fund gets created, 1 for 1. It's very, very important, because what has actually happened is we've stripped the dividends that used to be associated with those 100 shares, and we've now attached them to 100 units. So you can see it on the sides there. And now the farmer can sell these 100 units to any person in the public. It's now traded on the NZX and the ASX. He's now trading in a very, very liquid market. He's getting the benefit of external investors, getting the benefit of being traded on the major exchanges. But what he hasn't given up is control and ownership of his co-op, because his share is locked up in this lockbox, in this custodian. That custodian is jointly owned by all Fonterra farmers. You can now sell those units, and they're sold. He's benefited from the liquidity of this public market. And then the same happens in reverse. If he's a buyer, can't find any farmers to buy his shares, he can come onto this very public market, liquid market, buy 100 units. Now owns 100 units, he's easily bought them, very liquid market, comes back, brings it back to the lockbox, those 100 units gets cancelled off issue, and 100 shares come out of the lockbox and come into the farmer's name. As you can see by that, what actually happens is this fund breathes. It gets bigger and smaller as people buy and sell, and that happens every day. Trades every day, fund gets bigger and smaller every day as that works. And as I said, the beauty of that is farmers now have the benefit of a liquid market. They can buy and sell when they want. And importantly, they get good price discovery, because this is the most traded stock on the NZX and traded on the ASX as well. And so they can demonstrate they can buy and sell, leave the co-op when they want. If I go back to very start here. Shareholders must be free to enter and exit. It's enshrined in legislation. Fonterra needed to demonstrate whichever solution they came up with, that a farmer could buy and sell shares when they wanted to. So the beauty of that public market that provides diversity and liquidity is that farmers now have good price discovery on their shares, and they can buy and sell when they want to. So perhaps some other examples, I think Namoy cotton was mentioned before, Ron might have mentioned it, is with the CCUs. The reason why that solution wouldn't work with Fonterra is it acts similar to a different class of share. And Fonterra looked at that particular model, and the challenge with that particular model, with a B-class share, is you could have it traded on the public markets just like the units, but it couldn't be transferred. It's not fungible. The word's fungible. Couldn't be transferred 1 for 1 for a share. They actually trade at different prices. These two markets trade at identical price. Because of the ability to transfer one to the other, farmers can do that. These two markets trade at the same price. A different class of share, which is not fungible, will end up in resulting in different prices, and that wouldn't satisfy the legislation requirements in New Zealand. That's why that type of model would not work there. Now, that's how it worked for New Zealand. What's the importance to Australia here is Fonterra, as I mentioned, their aspiration was to solve for permanent capital. This was launched in November 2012. Fonterra hasn't redeemed $1 since this was launched. So it's sold for permanent capital. No longer has capital washing in and out of the balance sheet. And because of that, they can now offer farmers more flexible options for joining. Fonterra farmers can now join up over a period of 6 years, I think. So they no longer have to come up with $500,000 of shares in day one. They can now do it over a period of time because Fonterra is no longer concerned with capital washing out of the balance sheet at short notice. So that's why it's solved those two goals they were looking for. Where it may work for Australia is Fonterra could very easily do a rights issue, that is, raise more capital through equity. Shares, additional shares that get created when that happens. Create new shares, they go into the lockbox, they don't go to external investors, creates a bunch of new units that can be sold to external investors if Fonterra can use that capital for what they choose. So although that wasn't the aspiration for Fonterra, that's very much a consequence of the model, is that you could raise external capital using this. You still get the benefit of having a liquid market for Fonterra farmers, but you all of a sudden can now tap external investors for capital as well, without giving up what's on the left of the screen here, without giving up, most importantly, the voting. Anthony, I'm at the end, so I'm very happy to take any questions.
Wow, that was fantastic. Let's everyone just thank